Hello, everyone. This is Andrew McNair from SWAN Capital with our February 2024 SWAN Report. In this month's video, we're going to discuss some recent headlines that influence the financial markets. But I want to distill this information and share with you the perspective that we have here at SWAN Capital on these developments that may lie ahead for you as an investor over the next few months. Now, please stay tuned at the end of this video for a required disclosure statement. Now, remember that this is not personal financial advice for you and your family. That's why we have our complimentary discovery visit, and we run sleep studies on families' finances to make sure that they give personalized financial advice. Now, at SWAN Capital, our market outlook remains cautious because of world conflicts, higher consumer credit, coupled with higher interest rates. And the big question is, how high will the S&P 500 go? The index has topped 5,000 for the first time ever earlier this month. After finishing at new records over Super Bowl weekend, the markets got a rude awakening when the CPI, the Consumer Price Index, actually came out in January higher than many people expected. The markets shrugged off the Federal Reserve Chair Jerome Powell's warning after the most recent Fed meeting that 6 rate cuts were a bit of an overreach. But when the latest CPI number showed inflation remains stubbornly sticky, markets finally realized that this imminent rate cuts aren't on the horizon. It also became apparent that the current interest rate environment may persist until we see inflation drop from its current level of 3% down to the Fed's target of 2%. And this is why you've been hearing me in reviews at our State of the Market talking about that these interest rates don't necessarily have to come down as fast as the market anticipates and analysts think they're going to. The news sparked fears that rates would remain higher for longer and possibly even spur a recession. And the market rout was on. Reserve Chair Jerome Powell on Sunday, he came on 60 Minutes, said that he saw no need to cut rates immediately. The comments were especially concerning since the interview was filmed prior to the latest jobs report showing that we added 353,000 jobs last month. If he was determined to keep rates steady before, a strong jobs report definitely won't change his mind, and that's in direct conflict with the market's narrative of rate cuts happening soon. They're expecting 4 to 6 rate cuts, and many people have priced this into the run-up in the market. Later in the month, retail sales declined much more than expected, and the talk again shifted how soon we might see rate cuts. Again, this overemphasis of the market looking at the rate environment. The S&P 500 bounced back, and we ended that day at a new record high. But then the Producer Price Index, PPI, came in higher than forecasted on Friday, slapping markets around again as we closed out the week on a down note. It happens all the time. Fresh highs make markets really squirrely and hypersensitive to any news that either supports or refutes the narrative. These stokes of volatility and things spiral from there. However, market sentiment is still very positive, and markets have a clear desire to move higher. It seems we've abandoned expectations for 6 rate cuts in 2024 and are now content with maybe just 3. The Fed initially proposed starting mid-year. So again, like I talked about in the State of the Market, we expect maybe a strong year this year, but our concerns are starting to rise as the Shiller PE ratio and the Buffett indicator are flashing yellow and red lights. The good news is markets are in a positive mood and able to muscle through the waves of negativity for now. But as with all markets, the sentiment will shift and we will have a correction sooner or later. And we'll talk about how we could handle that below. But it's full steam ahead, at least for now. If the markets do drop 1% from a recent high, here are some things you can do to keep emotions in check for you and your family's finances. Number 1 is stop obsessing over hourly and daily fluctuations. If you need to turn off notifications from your email. Market dips are normal. We've had a mid-sell-off at the end of January for a day after the Fed meeting, and we had a one-day sell-off this month. And we generally have a couple big corrections every year. That's to be expected in the stock market. You need to keep an eye on the bigger picture. This is especially true if you have a longer time horizon. If you don't need money for a while, why are you stressing? If you're not going to be pulling income from that account that you're worrying about for 3, 5, or 10 years, you should put that on the back burner of your subconscious. Next, you have to review your goals. This is why we have financial plans for our clients. If you're on track to meet your goals, but still nervous when markets decline, perhaps it's time to reconsider your risk tolerance. In the current rate environment, you have better choices for some measure of safety than you did in the past. You can get government bonds that pay 4 to 5%. We have money markets that are paying 5%, or you can look at MYGAs with higher payouts. But if you want the potential to earn higher returns, you need to take on more risk. Risk and return have a relationship. Volatility is the price you pay for higher returns. Consider reverse dollar cost averaging just for a second. Each time the market hits a new high, pull back some of your allocation into something more conservative. Just make sure you consider the tax implications. Let us know if you think that your risk tolerance has changed or if your plans for retirement have changed. We want to hear feedback from all of our clients and stay up to date with them in their lives. Now, if you're confused about the current state of the economy, you're definitely not alone. That's why we put out the state of the market. If you haven't watched that 40-minute video, you're missing out. The data does appear to be puzzling and conflicting. Jobs are strong, and the unemployment rate has been below 4% for 2 straight years. Markets are chugging along, and consumers are still, consuming, even to their detriment. But it all seems to feel a bit tenuous and unsustainable, especially to Americans who say their long-term financial confidence feels fragile and vulnerable to social and political threats. That's going to be it for this month's SWAN Report, and I want to thank you for listening every month like many of you do. If you have questions about your personal financial plan, maybe you need to schedule your review. Maybe you need to schedule your first discovery visit with our office. We encourage you to do so by just calling 1-800-848-8768. That's 1-800-848-8768, or check out our Calendly app that is located on our website or on Google. We look forward to talking to you soon, and we'll see you next month.